Thanks for watching. The average pension fund in the United States has been in a slow-moving crisis for well over a decade. Almost every year they've trailed their required rate of return, and this has led to a massive shortfall of close to $1 trillion. At first this seems forgivable. Investing is difficult, and politicians and corporate executives have the tendency to overpromise to their beneficiaries and then disappear into retirement or quit or be fired. But it turns out this massive shortfall by pension funds has more to do with a systematic misunderstanding of risk and return. A few weeks ago, Mark Spitznagel, the founder of the risk mitigation fund University Investments, wrote in the Financial Times that the 60/40 portfolio had underperformed equity markets by a cumulative 250% since 1996. That's a huge underperformance and includes several major stock market crashes. Investors are well aware that stock markets are far more volatile than bond markets, especially after the crash of 1987, and they want to do what they can to minimize the risk of crashes. So what was the solution to minimize the damaging effects of large crashes on an equity portfolio? The solution was to pile into bonds and even lever up bonds with such funds like risk parity. Investors also use faulty ideas like modern portfolio theory, correlation, and the mean variance framework. This contributed to this higher concentration in bonds. In fact, stock and bond markets often have a positive correlation rather than a negative correlation. The goal was to minimize the risk of stock market volatility while getting the same returns. But clearly that hasn't happened, and pension funds are in real trouble. So what are the ramifications for the investment community going forward, now that pension funds have a clear problem? Diversification has always been a cornerstone of investment, but if you're diversifying to the point where your returns are so much lower than the alternatives, then none of this makes sense. And it looks like investors are starting to figure this out. One of the hedge fund kings, Ray Dalio, is already losing client money under management because of poor returns. So going forward, we're likely to see that a lot of these alternative investments are not paying out. They cost too much money, and they actually lower your risk to the point that the alternatives make even more sense. Thanks for watching.